So what if all of the data that we relied upon to make informed judgments about the state of the economy and the world around us were false? What if the basic information that we relied on from the US government that reflects the state of the economy, inflation reports from CPI, the growth of the economy, gross domestic product, or even fundamental data about the number of jobs? Well, that's the question and the world that we live in today, when we've just seen that the Bureau of Labor Statistics has overstated the number of jobs created this year in 2024 substantially by over 818,000. Hello, everyone. I'm Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. This is the Stormwall Advisors monthly update for the month of September 2024, and we're going to get into a deep dive on the state of the employment market and what that tells us about the economy. I want to start by saying I've been talking about issues with the data coming out of the government for quite a while now. Earlier in the year, we talked about how CPI data was understating the actual level of inflation in the economy. We've talked about how estimates of gross domestic product, in other words, the national income of the United States, has also likely been overstated, especially in real terms. In other words, when you combine those two things, the actual inflation rate and the real growth of the economy after inflation, it doesn't take much of an underestimation in CPI for real gross domestic product to actually be turning negative. If you're watching this and you like it, please give a share, a like, and a subscribe here on YouTube. Helps out a great deal. Let's dive into the data as we usually do. I'm going to switch over and share my screen, and we can go through some slides quickly. I'll come back at the end to go through what it all means. Where did all the jobs go? This is a question that I posed a week or so ago when this data came out. Even today, as a flash update, September 6th, the latest payroll estimates show that there were fewer jobs created than was expected. But let's get into the heart of the issue, which is the jobs report that the BLS came out with. So the BLS employment data for March 2024 was revised by a whopping 818,000 downward, in private sector by 819,000, offset by about 1 million new jobs created in government. We'll come back to that later. And almost half of these disappeared jobs were from higher paying professional services sectors, where the loss of those jobs or the absence of those jobs actually has a greater impact on the economy than if they were at the lower end of the employment market. There's a couple things to note about this. Number one, this was the second worst mistake by the BLS estimates since 2008, 2009, in the depths of the global financial crisis. And it's the 15th downward revision in their preliminary estimates since 2022. So this is the gang that cannot shoot straight. And this information has been substantially misleading over the course of the past few years. Now, why would that be the case? Well, the initial preliminary estimates always get the headlines, always get the news, and very few people actually pay attention to the downward revisions that have occurred since then. One could argue that this is actually politically motivated. I don't know. But what I do know is that the model that the BLS uses is, let's say, unreliable. Garbage in, garbage out. This is all based on assumptions. It's not that the Bureau of Labor Statistics actually goes around calculating the number of jobs created. They use a model, what they call the birth and death rate model, not of people, but of firms, of companies, to try to estimate whether there are new jobs created, and if so, how many. And it's proven time and time again that this is substantially inaccurate. Now, it's also been the case that the private sector estimates of jobs have been well below the BLS statistics for most of this time. And one of the leading providers of private sector employment is ADP, Automated Data Processing, one of the largest payroll processing companies. I believe they are the largest in the United States. Their data clearly indicates significant weaker employment growth. And if you look at their data over time, ADP indicates that total private employment, private sector employment, has only grown 6% in total since December 2019. So that's about a 1.5% a year, substantially lower than what the government estimates are showing, and indicative of a very weak economy over time. The ADP data also indicate that manufacturing, IT, information services, professional services in general are all in decline, whereas education, health, which you could consider derivatives of government jobs based on where we are today with our public schools and public health programs, and then leisure and hospitality, construction, transport are growing, but somewhat weakly. So let's move on. Now, the other thing that I think is important to note here is that real earnings after inflation are actually flat versus 2019. And you can see this because you look at the peak of where earnings were right at the middle of lockdowns in 2020. Since then, weekly real earnings, what someone takes home on average, average American family or earner, has declined. It's declined by 6.4% since the second quarter of 2020. Now, part of the problem is that what has been done is not easily undone. So if you look at real wage growth, it's been below CPI for 2 years. Most of 2021 and 2022 started to tick up in 2023, but this was too little and too late. And disinflation, in other words, lower levels of inflation, is not the same as deflation. Disinflation means the rate of inflation is slowing, but price levels are still high. And that's where we've been. We see price levels significantly higher. We'll come back to that in a second. We need actual deflation or much more aggressive real wage growth if we're going to see that the American family can catch up. In the meantime, big companies across industries are shedding jobs. We've seen it especially in the tech sector, where since 2020, there have been over 660,000 layoffs. But it's not just tech. If you look across manufacturing, retail, et cetera, consumer product companies, big companies are shedding jobs. It's the big companies that actually represent most of the jobs and historically the job growth in the U.S. So this is a pretty bad sign. We do see unemployment levels rising, with jobless claims now at the highest level since November 2021. We did see a down tick slightly this month in August, or the end of August, from July's highs, but still not an encouraging sign. Now, U.S. economic health, clearly we've talked about this and talked about it last month. You can see it very clearly in the retailer comparative store sales performance. Most retailers, especially those in home improvement or home goods, have been in decline for several quarters now. Essentially, the consumer is closing his or her wallet to everything but the most essential purchases. If we had added the grocery store supermarket chains to this chart, we would see that their sales are up. That's largely because they've been pricing to inflation, and as food inflation was very high in 2022 and part of 2023, those comparable store sales kept up. Not so for any discretionary items such as Home Depot, home improvement type of items. Now, in terms of government data, we also noted that the second quarter GDP was actually revised upward to 3% compared to 1.4% in the first quarter. So some positive trends. But what I notice about this is it's actually government spending that's growing faster than either private sector consumption or private domestic investment. In other words, the growth in GDP or the acceleration of growth in GDP is largely attributable to government spending, as opposed to private sector, where real productivity and real value enhancement takes place. The growth in government spending has been up 33% over the past, I believe it's 8 quarters here, compared with either those two, personal consumption or private investment at lower rates. We also saw in July that the headline inflation came down to 2.9%, so finally under 3%. Core, excluding food and energy, still up 3.2%. And what the underlying reality here is it's no longer food and energy that's driving the inflation narrative, but actually it's the more persistent sticky items, services, shelter, transportation, that continue to show either high single-digit inflation or in some cases double-digit inflation, as in the case of auto insurance, which on average is up a whopping 18.6% over the last year. But in general, even transportation, if you've had to buy airline tickets or other things, the prices are significantly higher, starting to come down a bit now. But even running a household, so household operations, repairs, domestic services, up nearly 7% over the last year. And I think the more fundamental point is that even with inflation coming down, the damage has already been done. So we see here that if you look going back all the way to 2008, the price increases across services like tuition, hospital services, childcare, Medicare, food and drink, up 50, 60, 70, up to 100% for hospital care. And there's been deflation in low-cost items, in discretionary spending, consumer electronics, toys, software, apparel, things like this that people don't need and don't have to live on, compared with food, with energy, and with the kind of services that we're talking about, medical, healthcare, tuition, et cetera. Effectively, over a generation, there's been massive inflation in these sticky categories. And if you look over a shorter period of time, really since lockdowns, again, it is across all categories: transportation, food and beverage, housing, et cetera, up over 20%, all items across CPI categories, 21%. And until that is diminished, reduced, we're going to have ongoing pressure. We saw it in Dollar General, the retailers, the value dollar store retailers results, which came out right at the end of August, confirming the weak consumer. Their shares crashed by 1/3 on the day of the earnings announcement, as the market realized that, really the most basic of all goods for the poor, for the working class, they're in trouble. Their sales were up, but nominally just about the same as CPI. They noted there's more traffic in the stores; people are coming in, but buying less. And they had flat comparable store sales. What's interesting, though, is they're under a great deal of profit pressure. So they're talking about having to make bigger markdowns to get people to buy things, more shrinkage, in other words, theft, people walking out the door with goods rather than paying for them, and the need to shift to consumable items like packaged foods and other things, because people just aren't buying the more non-discretionary items, which collectively brought their total profit, operating profit, and earnings down by over 20% in the quarter. CEO noting that soft sales attributable to a core consumer who feels financially constrained, no doubt. Now, I mentioned last month, that the home goods retailers are struggling. Big Lots seems to be teetering on the edge of bankruptcy. We're seeing pain all across the home goods sector. And equity markets seem to continue to be disregarding it. So markets remain at an all-time high or near. Now, historically, September is the worst month for stocks out of the year. We'll see if that holds true here in 2024 as we go into the month. But if you look at the S&P, it's just barely off its all-time highs. And in fact, some subsectors within the S&P indexes are at their all-time highs, including financials, industrials, materials, and healthcare, all at all-time highs. And if you look at a couple of measures of fair value, overvalued, undervalued, whether it be price earnings ratio using the Shiller model, 35.7 times definitely overvalued. The Buffett indicator, which is a ratio of the market cap of all equities versus the gross domestic product of the country, at over 200%, clearly another indication that asset prices remain elevated and high. Interesting to note that out of all of those markets, commodities and bonds kind of are lagging. Gold, as an inflation hedge, has beaten most of the stock indexes this year, up over 21% year to date. And Bitcoin, in spite of a big pullback in the last few weeks, still remains the second best performing, just behind NVIDIA at 37.6% against NVIDIA's 125.8% increase, and technology more broadly underperforming relative to those specific assets. So another indication here that we are still at a very lofty valuation level is the dividend yields are low and poor at 1.3%. Over a very long sort of 50-year history, this is the lowest level we've seen. And comparing to an average of 4.1% tells us that people aren't getting paid cash for their investments, paying big prices to hold on to them. Just a few closing thoughts here. Number one, the job data suggests the economy is much softer than the mainstream narrative and the proponents of Bidenomics would lead you to believe. There's a lot of debate right now about whether the Fed will cut rates in September as a result of the weaker jobs and employment data. We'll see. There's still a risk that that is going to trigger a new round of inflation. So I think the Fed will have to be cautious. I mean, the market is pricing in almost a certainty of rate reductions. So that is probably already priced into equities and other asset values. And I think the point to just notice is there is now this disconnect in inflation between food and energy, which has now come back down and is moderating with some deflation even in energy prices, and structural items like shelter, like services, where inflation continues to be elevated and remains growing at high single-digit rates. We've talked before that eventually this bubble, this everything bubble, has to pop, but no one can predict when. Well, you can predict it, but no one knows. But I continue to assert that the idea of a soft landing is a fairy tale. I hope you've enjoyed it. It's going to be interesting to watch what happens over the course of the rest of the year. If this has been helpful for you, please don't forget to like it, share it, and to subscribe to my channel on YouTube. Also, you can go to stormwall.com to pick up on all of my videos, all of the articles that I publish, all the media that's out there where we talk about these and many, many other issues. In the meantime, we will see you next time on Stormwall Advisors Monthly Update, and wishing everyone a great September.